Market efficiency was a phrase that was coined by Eugene Fama in 1970 in a very important article in the Journal of Finance. Fama defined efficiency as a market that correctly incorporates information as soon as possible. So efficiency is about a number of things. First, it's about the correct interpretation of information. So if information is released about a firm that really has no consequence on the future prospects of the firm, then we shouldn't see the case that the price fluctuates and perhaps overshoots or undershoots where the price should head. So efficiency is fundamentally about the correct interpretation of information. The second thing efficiency is about is the speed to which information is incorporated into the market price. Now, in a completely or totally efficient market, information is reflected immediately, instantaneously in the stock price or the bond price. However, one thing that is really clear in studying Fama's work is that market efficiency is a relative concept, that no market is completely efficient. There's always going to be some degree of inefficiency in all markets. Efficiency is a relative concept. So I can safely say that the stock market, the NYSE in the US, is more efficient than any other stock market in, let's say, emerging markets. It's clear that that's the case. So efficiency is a relative concept, and it has to do with the speed to which information is incorporated. It has to do with the way the information is interpreted. Now, this concept is, I guess, very much misunderstood by a lot of people, and it is subject to a lot of study in the second-year course in investment and the international investment course. Now let me tell you the difficulties in dealing with market efficiency. But first let's go back to the original Fama definitions of market efficiency. He grouped market efficiency into three different classes. The first is what he called the weak form efficiency. And this suggests that you could not make extra money by investing upon information that was very easily obtainable in the form of past prices. So given the past price history of a security, it doesn't make any sense that you could form a trading strategy to profit upon that. The past history is basically free. It used to be the cost of a Wall Street Journal, and now it's an internet connection. Given that the price of that information is so cheap, it doesn't make any sense that you could develop a trading strategy to profit upon that. So a lot of papers in the 1960s tried to test that hypothesis by constructing tests of autocorrelations of returns, runs tests, and other sort of technical trading rules. And they found that it was not clear that you could make any extra money using those strategies when applied to stocks that were traded on the NYSE or the Amex. Now, the next level of efficiency is what Fama called the SemiStrong form of efficiency. In this form, it suggested that you cannot make extra money by using any publicly available information. So this goes beyond just the past history of prices and now includes information perhaps about earnings announcements, stock splits, you know, information that's released from the firm that appears in the financial press. Another good example is the Wall Street Journal column, Heard on the Street, where so-called tips are given out, what stocks are going up and what stocks are going down. Given that, you know, the price of a Wall Street Journal is not that high, does it make sense that you could use that to make extra trading profits? And according to the SemiStrong theory of market efficiency, the answer is like no. And the empirical studies generally suggest that this is the case. There are some exceptions, but generally the publicly available information is very difficult to make extra returns based upon it. Now, the third and most extreme form of market efficiency is the strong form. And this basically says that there's no information that you could use to make extra money, that the prices are set exactly correct. So this would include insider information. And the empirical evidence here suggests that the markets are not strongly efficient, that there is a profit to be made from trading on inside information. Now, I'm not suggesting that you go trade on inside information. Of course, you have to differentiate between information that is legal and illegal. And we never trade on illegal information because if we do our net present value calculations, aside from it being against the law, there's a huge negative skewness in our potential returns to that information. So in the form of jail time or whatever. So that always has to be factored into our calculations. So the strong form of market efficiency does not hold. Now, this is the difficulty in dealing with market efficiency. I've said you should not be able to make extra profits. And I've referred to what the price should be. Well, what is should? What is the true price? This is the dilemma in actually testing for market efficiency. In that somebody could say, oh, the market is really underpricing this security. It's trading for $40 when the price should be $50. Where's the price of 50 come from? How does this person that claims that the true price is 50 get that information? What is the mechanism which tells us that the true price is 50? Well, there is no mechanism. We don't have the true model of price formation. All we have is approximate models. And some of the models we've actually gone through, like the capital asset pricing model. It delivers an expected return given the risk. So what we could do is we could say, well, this stock should have had an expected return of 20% given its risk. And you can see that it had a realized return of 30%. This gap between what was expected and what actually happened, one could argue has to do with market efficiency. You could say that the stock went up too much. It overshot. Therefore, the market is not efficient.